Ladies and gentlemen, good morning. A very quick review of the action of last week. And as we can see in the 2-year note, the, uh, the action has been basically bearish in fixed income all week. We had a pretty decent fall in price, higher in yield, which was basically erased by the FBI revelations late on Friday. This market looks like it will consolidate throughout next week, maybe going slightly higher as people have a bit of a flight to safety ahead of the US election. That is best seen in the longer end. The yield curve keeps on steepening. This is TLT. The market was under pressure all week and basically gapped below. We might get some gap filling back up towards the 132 area, but this market now is well below the 200 period moving average, and the 100 period moving average is beginning to roll over. So we would not be surprised if the election uncertainty over the next couple of weeks causes a slight rally in TLT, going back towards the 132, 133 area. But if that is all the market can manage over the course of the next couple of weeks, we think the likelihood is very high that we move towards the 127 area. And should we break the 127 area, then we are in a completely new ball game. We are looking for much higher bond yields. We don't know what the catalyst for that will be, but this chart is beginning to look ominous. It could be making a very long-term head and shoulders, which could probably be best seen on the weekly chart of the US bond. If we now play in this area here for a number of weeks, then we could really have a fall back down towards the 144, 142 area, which is going to be somewhere around the 3% yield mark in the States. Very ominous beginnings of a big change in the bond markets. The weakness on Friday, even though the 2-year note managed to rally and the short end managed to rally, it indicates that people are still unwilling to buy the long end, and that yield curve steepening might well continue here in the medium term. Much the same can be seen in the European charts. This is a yield of the Bund yield chart. For the first time in absolutely ages, the 200-day moving average, or the 200 period moving average, has started to look positive. We think that we might well get a move back over the course of the next 10 days or so towards this 9 to 7 yield area. And this will be an area where we will be interested in buying some long-term puts on the bund and calls on the yield. We think this might be the very start of a much higher yield breakout in the European markets. We took off our Bund BTP spread because we were basically bored with it. We probably made a mistake. We will continue to look at re-establishing that, and we will be looking at having basically short positions in Europe and in the US in fixed income markets. After this period of weakness has elapsed over the course of the next few days, as people shift assets towards safer homes for the US election. And this is a weekly chart of the dollar index. As we can see, its advance was stopped dead in its tracks by the FBI. We think that a retest of the breakout area around the 96.5 to 96.75 area is probably likely in the next 2 weeks, and then we will see what happens. This is very much confirmed by the daily chart of the euro. We now have a positive momentum move to the upside. Likelihood is that we go and test at least the 111 area, if not the 111.40 area, over the course of the next few days. Typical pre-election trading, people moving out of trend positions and squaring up, and even being whipped out at the top of the range. As you know, 111 is very much the top, we think, for the time being, but we would not be surprised to see spikes of 111 just basically to get people out of their positions and trigger stop losses. But while the market continues to be below this support line, we would not be surprised by a retouch of it, but certainly we think that the trend of the dollar continues higher after this backing and filling has taken place over the course of the next 10 days or so. Moving on to equities, this is a chart of the weekly DAX, and it has made a pretty nasty candle on the weekly charts, closing back below the level that it was threatening to break on Friday. We could have easily moves back towards the 10,300 area, testing of that support line again. Even better seen in the stocks weekly chart, where we could easily have moves back towards the 2,980 to 3,000 area before we get the results of the US election. We would prefer shorts to longs in all European markets, stock markets next week, simply because we think that if the dollar is stronger, they have more room to fall than US markets, which is counterintuitive, but that is probably the way it's going to work. People were long Europe over the past couple of weeks, rightly so, because of the weaker dollar. Now they will probably be stopped out of their positions by a retest of this level, which is very important, 2,980. If the market manages over the next couple of weeks to stay above 2,980, we will be turning bullish and we'll be looking for retests of at least 3,150 after the US election. What of the US market? Well, that's probably going to be the toughest one to trade. We think that the moving averages have definitely turned lower. The shorter term moving averages, the longer term moving averages are still around the 2050, 2070 area, like the 200-day. So the pressure will continue unabated on the US markets until they are very, very oversold. We would be surprised if the 2000 level at some stage is 2100 level, I apologize, it will not be retested. But the US market has been very, very resilient. We were surprised by how well it held in on Friday, but we will again be surprised if we do not see signs of panic at some stage over the next 5 days. Moving on to a shorter period time frame, like the 300-minute on the ES, we can see that quite clearly. The moving averages are all well above price, and this 200 period moving average has held the market very well over the past few weeks and days. while it has this negative slope and is catching all the tops around the 2140, 2145 area, we see that very much as very strong resistance and areas that you can quite easily short against the 2150 close. Given this pattern, it would be not surprising to see pressure persist and possibly crack the 2100 level. We think it's going to be unlikely that the 2100 level survives over the course of the next 10 trading days, simply because the fear in the market is going to be too great. We are not bearish, and we will show you in a moment why we're not bearish and why we think that these drops are all buys. On the other hand, our conviction cannot be as high as it used to be, simply because a Donald Trump victory would be a complete game changer. We don't know what equities might do in the first couple of days of a Trump presidency. There might be complete panic and even, falls of the magnitude that we had in basically over Brexit. So we could have real falls, even of the magnitude that we had last year in August. So you just cannot anticipate how spooked the market might get by such falls. Therefore, we think it's going to be better to play any conviction through options rather than through outrights, unfortunately. So it's better to be safe rather than sorry at this stage. Having said that, we just cannot get bearish of the US market, not while emerging markets are as strong as they are, not while Europe is no longer going down but looking to go up after retracements. So we just find it very, very hard to get very negative of equities. And here's another chart that confirms that, the Nikkei. How can you get overly bearish of this chart? It's held the 200-week moving average. The shorter term moving averages are now condensing and trying to move higher in slope. Again, we would not be surprised to see this come back and retest the 16,300 area. But while we are above 16,300 over the course of the next couple of weeks, all this will have been is backing and filling and ready for a move back up towards at least 18,000, possibly 20,000. So while that is happening, we are finding it very, very hard to get short of the US markets. Volatility is still very low. This is a chart, a daily chart of VXX. We might get true spikes. The spike on Friday might have been nothing compared to what you will see over the next couple of weeks, depending again on the election results. But the one thing that we know, and we are absolutely convinced of, is that at some stage it will be much better to be short of volatility than to be long of the US market, of the ES. We have certainly now a bullish move to the upside in the volatility index. We would not be surprised to see continuations of these bullish moves and possibly fills of this gap around the 22 to 23 area. We still consider such moves as great opportunities to short volatility. And the reason why is simple. Look at how low historic volatility has been for the past several weeks. naturally a Trump victory would throw this out of the window. But if you have a market which has been strangled in a 2 to 2.5% range for the past, oh, we don't know, I mean, what was that, 3 months almost, it is almost impossible for implied volatility to remain above historic volatility for such long periods of time. And given the fact that the yield curve is now so steep in terms of volatility, we still find it incredible that VXX can remain at these levels without a very much higher additional levels of volatility in the historic time frame. So basically the only way we see volatility still rising and staying bid is if we basically go and test at least the 2060 area, if not even all the way down towards the 2000 area. That to us is extremely unlikely for the following reasons. And here are the fundamental reasons why we think the S&P will not break down and stay down for very long. Earnings season is now over. It turns out, well, effectively over. It turns out to have been somewhat better than the very low bar which was set for it by Wall Street, which is often the case. The Blue Angels are turning up nicely. We have very strong support just below 2100 in terms of the 16 times forward earnings Blue Angel. Do we exclude a possibility of a fall to the 15 Blue Angel like it happened in August of last year or early this year? No, we don't, but those were periods when the Blue Angels were either flat or descending. So we think that the likelihood of an immediate break of time 16 can only happen in terms of a Trump victory and a complete panic in the markets. Given the odds that the bookmakers are giving on that, still, even after Friday, we think that that is extremely unlikely, and we have to bet against it. However much the bookies got it wrong on Brexit, we still have to go with the historical trend, and that is that they are more often right than wrong. Therefore, around the 16 times Blue Angel, we have to be buying. If we look at the sectors, we can see that the market is no longer so hugely overbought. The discretionaries have been pummeled back, and a small move back down to time 16 can naturally not be excluded. The staples are quite firm, but they're no longer anywhere near as overbought as they were a few months ago. Energy we will ignore because that is such a mess. But the financials are in a very good position to rally and continue rallying and be the driver to the upside in ES. It is almost inconceivable that the broader market can fall too much given this strength in financials, which we think it continues. Healthcare is now so oversold that we are right on top of the 14 times moving average. So we tried to do some bottom fishing in that on Friday. For the long term, we like healthcare for the very long term, and buying it against the 14 times Blue Angel has very rarely been wrong before. Can the market go down? Yes, of course it can. Can it go down to the times 10 Blue Angel? Yes, it can, and it did in 2008, but those were very, very extreme times. We're not saying those times cannot come back, but for the time being, we are looking up on XLV, so that one of the major drivers down of the index is disappearing. The one we don't like still is the industrials. We think that has very little upside, so that will be a drag. But tech is still very well supported. There are the first signs of weakness in tech at the moment, and tech could very well give up 3 to 4, 5% on election worries before it resumes its path upwards. The trend is of the Blue Angels and of the earnings expectations is quite clearly higher. So unless information technology has at least a 10% drawdown, we find it unlikely that the broader market can fall too much. Materials can probably fall another 2 or 3%, but that is immaterial. And finally, telecommunication sector, which is a very small weighting, has been pummeled and is now ready to rally again. The utilities also can get pummeled as the bond market yields rise, but it's very unlikely to continue in the medium term.
Well, having said all that, what are our biases for next week? Well, nothing has changed as far as we are concerned. We are still looking for some extremes, and it will be just a question of whether we are brave enough to buy those extremes. The 2180 area can now be substituted by the 2140 area in ES. That is now going to be very good resistance. Anything below 2100 we still think is a major buy. The Bund BTP spread is quite unrealistic now at 120 basis points. We will refine that next week. TLT all squeezes up towards the 137 area, maybe even 132 now, can easily be, or even, sorry, 134 can easily be sold. We will refine that again next week. On the dollar, 111 is very important, and we think it might get retested. As long as it keeps on closing below, we will be wanting to sell those spikes. And now the Stoxx 50 and the Nikkei, which were benefiting from the stronger dollar, might actually be sold off harder than the ES. So this might be reversed, but not for long. Gold, now we do expect some higher moves towards above 1283, possibly to 1300. But we still are not enamored with gold, and we think the next move again will be lower as the dollar recovers from these jitters pre-election. We still like buying emerging markets. We see that as a beginning of a secular trend, and buying of those on any spike down is still something that we wish to do for the longer term. The next couple of weeks are going to be very, very tough markets, so we are going to keep positions light and look to trade quite strategically and quite surgically. Volatility will still be a much better short at some stage than being long of the market itself. That is all we have for you today. Thank you very much for listening, and follow us next week